Friends, thank you for being here today. All right, so to really get what's going on, we have to start with a core problem, and that's this 35 to 37 trillion question, which is leading us into something that economists are starting to call the debt doom loop. What if I told you that the $37 trillion national debt isn't just an abstract number for politicians to argue about, but a ticking time bomb that's fundamentally breaking the entire global financial system? And what if I told you that the government knows this, and it has a radical high-tech plan not to fix it, but to quietly export the consequences to every corner of the globe? The United States finds itself ensnared in a precarious financial paradox, undefined by a staggering national debt that has ballooned to between 35 and 37 trillion. This is not merely a number on a ledger. It is a structural fault line threatening the very foundation of the American and, by extension, the global economy. This crisis is intrinsically linked to a privilege the United States has enjoyed for generations: the status of the U.S. dollar as the world's global reserve currency. This exorbitant privilege, as it has been called, allowed the nation to finance its ambitions, its wars, and its domestic programs by issuing debt that the rest of the world was hungry to buy. It permitted the government to run massive, persistent trade and fiscal deficits with seemingly no immediate consequence, borrowing at laughably low interest rates, because the dollar was the undisputed king. But the throne is wobbling. The privilege that defined post-war American economic dominance is showing profound signs of erosion. The most glaring piece of evidence is the dollar's declining share of global foreign exchange reserves. For the first time in recent memory, this share has plummeted, hitting its lowest level in 30 years. The world's central banks, the primary holders of these reserves, are diversifying. They are quietly and sometimes not so quietly hedging their bets. The dollar's dominance, once taken for granted as a permanent fixture of the financial universe, is now below the critical 60% threshold, and the trend is accelerating. This diversification is not a random fluctuation. It is a conscious strategic pivot by other nations who see the $37 trillion figure and recognize the unsustainable path it represents. This erosion of confidence is the ignition switch for a terrifying mechanism known as the debt doom loop. This is not a theoretical academic concept. It is a phenomenon that has toppled economies before, and it is beginning to manifest in the U.S. The doom loop is a vicious, self-perpetuating cycle. It begins with a loss of confidence in a nation's ability to service its debt. As confidence falls, investors, both foreign and domestic, demand a higher return for the perceived risk of holding that nation's bonds. This demand translates directly into higher interest rates. These higher interest rates in turn create devastating budget problems for the U.S. government. This is already happening. In a shockingly short span of time, the annual interest payments on the national debt have exploded, surging from approximately $500 million to over $1.2 billion. This isn't money for roads, healthcare, or defense. It is dead money paid out just to service existing loans. These interest payments now consume more than a fifth of the government's total tax revenue. This budgetary black hole forces the government to make an impossible choice: either implement crippling austerity measures, cutting spending, or raise taxes dramatically, both of which are politically toxic and economically damaging. The more likely path is to borrow even more money just to pay the interest, which of course absolutely destroys whatever remaining investor confidence is left. This completes the loop, pushing interest rates even higher and accelerating the death spiral. To understand the mechanics of this crisis, one must look at the 10-year government interest rate. This is the global benchmark, the rate that dictates the cost of money for everyone, from multinational corporations to home buyers. This rate is not arbitrary. It is determined by the interplay of three fundamental forces. The first is inflation. If investors expect inflation to be high, they will demand a higher interest rate to ensure their investment doesn't lose value in real terms. The second is the discount rate, the short-term interest rate set by the Federal Reserve. This acts as the anchor for the entire yield curve. But it is the third force that lies at the heart of the current crisis: the term premium. The term premium, which can also be called the risk premium, is the extra bit of interest that investors demand for the risk of holding a long-term bond like the 10-year Treasury instead of just rolling over short-term bonds. It is in its purest form a mathematical measurement of investor confidence. If confidence is high, the term premium can be low or even negative. If confidence is low, the premium sources. Herein lies the ticking time bomb. For much of the last decade, this risk premium has been near 0%. In an era of perceived stability and endless central bank support, investors were willing to hold long-term U.S. debt for virtually no extra compensation. The historical average for this premium, however, is approximately 2%. Today, as the $37 trillion debt casts its shadow and foreign buyers evaporate, that premium is beginning to rise from its 0% floor. The consequences of this single variable returning to its historical norm are apocalyptic. If the risk premium were to simply revert to its 2% average, the benchmark 10-year interest rate would instantly jump from its current level of around 4% to a staggering 6%. This would not be a slow, manageable increase. It would be a financial shockwave. A 6% risk-free rate would have disastrous immediate consequences. Mortgage rates would skyrocket past 8 or 9%, freezing the housing market in place. Corporations, which have gorged on cheap debt for a decade, would face a wall of bankruptcies as they failed to refinance their loans at the new higher rates. The government's own interest payments would balloon to truly unsustainable levels, consuming a third or more of all revenue. This single event would be the nail in the coffin, guaranteeing a deep, painful, and protracted recession. Now, this whole debt doom loop, it's not happening in a vacuum. It's being dangerously amplified by what you could call a macroeconomic powder keg of global and market instability. The domestic debt doom loop is not occurring in a vacuum. It is being dangerously amplified by a convergence of external macroeconomic pressures that are turning a manageable problem into an existential threat. The global stage is primed for volatility, and the U.S. economy is sitting on a powder keg. The most significant geopolitical risk is the escalating economic conflict between the United States and China. This is far more than a simple spat over consumer goods. It is a structural battle for economic and military supremacy. The long-standing U.S. trade deficit with China, where America buys far more than it sells, is no longer viewed as a simple economic quirk. It is now widely seen as a profound structural risk to American manufacturing, economic independence, and most critically, national security. This tension has moved far beyond the realm of simple tariffs. The economic chess match has become far more dangerous. China, recognizing its leverage, has begun to implement stringent export controls on rare earth minerals. This is a direct shot at the heart of America's advanced economy. These are not obscure materials. They are the irreplaceable building blocks for everything from smartphones and electric vehicles to the most sophisticated military hardware, including guidance systems for missiles and advanced avionics. China processes an estimated 90% of the global supply, giving it a terrifying stranglehold. The United States, in response, has not de-escalated. It has retaliated with its own severe measures, including rumored 100% tariffs and more strategically new export controls on critical software and semiconductor technology, attempting to cut off China's technological advancement at the knees. This tit-for-tat escalation creates a backdrop of profound instability. The global supply chain is no longer a given. Markets already jittery from the debt crisis now hang on every political statement, every social media post. This geopolitical brinkmanship means that global economic stability could be shattered overnight by a single ill-conceived tweet or a sudden executive order sending shockwaves through a system that is already at its breaking point. This external volatility is pouring gasoline on a stock market that already appears to be on borrowed time. Investors are trapped in a state of cognitive dissonance, watching markets climb to new highs, while the underlying economic fundamentals crumble. The market's current valuations are not just expensive, they are historically anomalous. Key metrics are screaming a warning. The technology sector's total weight as a percentage of the S&P 500, for instance, has now officially exceeded the peak of the infamous 2001 dot-com bubble. The lessons of that crash, it seems, have been forgotten. Furthermore, the Buffett indicator, a broad measure of total stock market capitalization, relative to the nation's gross domestic product, recently hit its highest level ever recorded. This metric, favored by one of history's most successful investors, implies that the stock market is more disconnected from the real economy than at any other point in history, including the speculative manas of 1929 and 2000. This isn't just a valuation problem. The fundamentals themselves are rotting from within. While the headlines tout artificial intelligence and endless corporate profits, the reality for the average person is deteriorating. Search volume for the term AI bubble has hit record highs, a sign of widespread public nervousness. More tangibly, credit scores are dropping at the fastest pace since the 2008 Great Financial Crisis. Private credit markets, the shadow banking system that provides loans to medium-sized businesses, are drying up, choking off growth. We are witnessing a bifurcated economy. A handful of mega capitalization stocks are levitating the indexes, while the real economy of small businesses and indebted consumers is slowly suffocating. The market is a skyscraper built on a foundation of sand, and the geopolitical winds are picking up. The third element of this powdered keg is the systemic risk building within the cryptocurrency markets. While advocates champion crypto as a decentralized alternative, the space has become a casino for high-stakes, unregulated leverage. This was demonstrated with terrifying clarity during a recent market flash crash, which triggered the largest single-day liquidation in cryptocurrency history. Billions of dollars in value were erased in minutes. The cause was not a fundamental flaw in the technology itself, but the massive institutional and invisible use of leverage. Platforms offering traders 100 times leverage, the ability to control $100 of an asset for every $1 of their own money, have become the norm. This is not investing. It is pure, unadulterated gambling. This leverage creates a fragile house of cards. The mechanism for collapse is a leverage cascade. A relatively small initial price drop, perhaps caused by the geopolitical or market volatility previously mentioned, triggers the first round of automated liquidations. These are forced selling orders for the most highly leveraged traders. This sudden massive wave of selling floods the market, pushing the price down even further and faster. This new lower price then triggers the next wave of liquidations for traders with slightly less leverage. This domino effect becomes an unstoppable avalanche, a cascade of forced selling that wipes out billions in paper wealth and completely dislocates the market all within a matter of minutes. This demonstrates that the crypto market in its current form is not a hedge against volatility, but an amplifier of it. Now, anytime you have this much chaos, this insurmountable debt, this geopolitical conflict, this market fragility, you're going to get some wild theories. And a really seductive one has emerged from the internet, a theory that promises a clean slate. You've probably heard it called the crypto reset. We really need to break this down and separate the fantasy from the fact amid this chaos of insurmountable debt, geopolitical conflict, and market fragility. A seductive and sensational theory has emerged from the depths of the internet, a theory that promises a clean slate. This is the crypto reset theory. According to reports, this narrative gained traction after originating in, of all places, a Russian economic forum. The claim is as grand as it is vague that the United States government is secretly planning to erase its entire $37 trillion national debt. The proponents of this theory, often speaking in conspiratorial tones, use a flurry of technical-sounding but ultimately hollow buzzwords. They claim the debt will be moved to the blockchain or uploaded to a crypto cloud. Once in this digital ether, they allege the debt can be mysteriously devalued or simply be made to disappear like a digital magic trick. This theory is intoxicating because it offers a simple technological solution to a complex, painful human problem. It sounds sophisticated, it sounds futuristic, it's also a complete fantasy. It is crucial to debunk this narrative, not just because it is wrong, but because it distracts from the real and far more subtle plan that is already in motion. The fundamental flaw in the crypto cloud theory is a profound misunderstanding of what debt is. The $37 trillion national debt is not a digital file like an MP3 or a JPEG that can be dragged and dropped onto a new platform. It is a vast, complex web of legal binding contracts. These contracts, treasury bills, notes, and bonds, are owned by real people, by pension funds, by corporations, and by sovereign nations. They represent a legal promise by the United States government to repay principal plus interest. You cannot move a legal promise to the blockchain any more than you can upload a mortgage. To simply declare these contracts null and void would be a default, an event that would trigger the immediate and total collapse of the global financial system, not a reset. The term crypto cloud is itself meaningless. It is a marketing buzzword, not a financial mechanism. This fantasy is bolstered by other equally speculative claims. One popularized by a prominent tech CEO is that the U.S. will sell all its gold and buy Bitcoin, creating a new crypto-backed reserve. This is a bold and fascinating opinion, but it is not an active government plan. The so-called strategic Bitcoin reserve that has been cited as evidence is nothing of the sort. It is merely a new government policy for how to manage the Bitcoin that has already been seized from criminal enterprises. It is an asset management policy, not a revolutionary plan to abandon the dollar and sell the gold in Fort Knox. Another related theory alleges that the government is using private companies such as MicroStrategy as secret proxies to stack Bitcoin on its behalf, building a covert national reserve. While governments are certainly capable of covert action, there is zero hard evidence to support this claim. It remains for now pure speculation. The reality of the government's plan is not a technological fantasy. It is something far older, far more cynical, and already in progress. The U.S. can reduce the real burden of its debt, not by erasing it, but by using a familiar and insidious tool, inflation. This is the oldest trick in the sovereign debt playbook. A government that controls its own printing press can never technically default on debt denominated in its own currency. It can always print the money to make the payments, but in doing so, it intentionally devalues the currency itself. The $37 trillion will be repaid, but they will be repaid with dollars that have a fraction of the purchasing power of the dollars that were originally borrowed. This is a quiet, slow-motion default, a debasement that punishes savers and rewards debtors. This is the real, albeit unstated, policy. And this is where cryptocurrency, not as a cloud, but as a tool, makes its true and brilliant entrance. The real crypto reset is not about erasing the debt. It's about finding a new and efficient way to export the inflation required to manage it. Okay? So if that whole crypto cloud theory is a fantasy, and believe me, it is, it's dangerous because it distracts from the real plan. And this is the part you really need to pay attention to. The real plan is far more subtle. It's already in motion, and it involves weaponizing a very specific part of the crypto world, stable coins. The real crypto reset is not a conspiracy. It is a clever, strategic, and legislatively backed maneuver to maintain U.S. dollar dominance in a new digital age. The key is not Bitcoin or a mythical cloud, but a specific and rapidly growing class of digital assets, stable coins. A stable coin, such as USDC or Tether UST, is a digital token. It is for all intents and purposes a digital dollar. Its purpose is to maintain a one-to-one peg with the US dollar, allowing users to transact on a blockchain with the speed and efficiency of crypto, but without the wild volatility of assets like Bitcoin. To achieve this, issuers of stable coins must back every digital dollar they create with a real dollar in reserve. This is where the genius of the U.S. government's real plan becomes apparent. Through recent legislation, which some have dubbed the Genius Act, regulators are mandating what stablecoin issuers can hold in those reserves. They are being systematically funneled away from holding cash or risky commercial paper and are now being required to back their digital dollars with the safest and most liquid asset on earth, U.S. Treasury bonds. This single legislative pivot is a master stroke. It brilliantly counters the most immediate threat to U.S. financial stability, the evaporating demand for its debt. As previously discussed, the core of the debt doom loop problem is the loss of confidence from major foreign debt holders. Nations like China and Japan, once the most reliable buyers of U.S. treasuries, have become net sellers. This reduction in demand is precisely what threatens to send the term premium soaring, which would spike interest rates and bankrupt the country. The stable coin market provides a perfect novel and non-governmental solution to this problem. The stable coin market is not a niche product. It is a global phenomenon that is exploding in size, having already swelled past $200 billion, and growing fast. This growth is not primarily coming from within the U.S. It is being driven by individuals and businesses in emerging markets. People in Latin America, Sub-Saharan Africa, and Southeast Asia who live under the threat of hyperinflation and unstable local currencies are flocking to stable coins. They see them as a lifeline, a way to access the relative stability of the U.S. dollar without needing a U.S. bank account. This creates a new massive and structural source of demand for U.S. debt, one that is completely divorced from the geopolitical whims of Beijing or Tokyo. Every time an individual in Argentina or Nigeria buys a digital dollar to protect their savings, the stablecoin issuer must by law go out and buy a U.S. Treasury bond to back it. The scale of this new demand is staggering. Projections from major financial institutions suggest the stablecoin market could easily swell to $2 trillion within the next few years. A $2 trillion pool of capital, all legally mandated to buy U.S. treasuries, would be a more powerful force in the bond market than the central banks of Japan and China combined. This new demand would effectively offset the selling from nervous foreign governments. It would act as a massive thumb on the scale, putting a powerful artificial cap on the term premium and helping to keep U.S. interest rates low, even as the national debt continues to climb. This is the clever strategy in its full form. It connects directly back to the government's real plan of using inflation to manage its debt. By encouraging the global adoption of dollar-backed stablecoins, the U.S. government is effectively exporting the pain of this inflation. When the Federal Reserve prints money via quantitative easing or other measures to devalue the dollar and reduce the real burden of its debt, the loss of purchasing power is no longer felt just by American citizens. That inflation tax is now quietly and efficiently spread to everyone on the planet holding a dollar-backed asset, including the millions of new users holding stable coins. The U.S. gets to devalue its debt, and the cost is shared by the entire world. It is crucial to understand, however, that this strategy does not erase the $37 trillion debt. The U.S. government must still make every single interest and principal payment. It is not a default. It is rather a way to spread the pain of the repayment, the debasement of the currency, to a much wider global audience, thereby lessening the domestic, political, and economic fallout. But this brilliant plan has a profound and ultimate limitation. Even a $2 trillion stablecoin market is but a fraction of a $35 trillion and growing debt pile. This strategy is a stopgap, not a solution. It is a way to buy time. Foreign investors in total only account for about 24% of all U.S. debt holders. The stablecoin solution is a powerful tool to manage the external confidence problem, but it does nothing to solve the internal problem of reckless runaway government spending. If the U.S. government views this stablecoin mechanism as a get-out-of-jail-free card, a green light to continue spending with abandon, then this plan will inevitably fail. The sheer volume of new debt will eventually overwhelm even this new source of demand. Confidence will be lost not just by foreign governments, but by all investors. At that point, the term premium will surge, interest rates will spike, and the doom loop will become uncontrollable. When that day comes,